Thank you very much, everyone, for joining. I'm Andres Garcia Amaya. I'm the founder here at Zoe Financial. But you guys didn't come to see me speak. Today, we have a great panel of experts on the topic of equity compensation. And so we call it your equity moment. Don't leave it to chance, because it's a really important decision that often is best to have a conversation before you have a liquidity event, before you have that equity uh, moment. And we have just the perfect people to help us with that. So I have the pleasure to introduce Grace Arnold. She's a CFA, CFP, and CDFA. 15 years in financial services experience. She's a former leader at a $45 billion retail investment firm. And she really focuses on building clear whole picture plans for big financial moments, such as this one when it comes to either an IPO and, as we'll discuss, other liquidity events. I've had the pleasure of working with Grace now for a couple of years and her firm, GreenUp. And she's just awesome professional, but also just a great person, a great human, if you will. So I'm really happy to have you join us, Grace.
Great to be here, Andre.
We also have Christian West from Rigdon Capital Strategies. He's a CFP, 15 years of experience, helps clients manage RSUs, stock options, and equity pay. Hence, obviously, why he's joining us today. He has a ton of experience on this topic. And maybe with that, we'll kick it off. I have a lot more comments around, both Christian and Grace and their expertise here, but the easiest way is to get right into it, right? So here's what we'll discuss. First, we'll go through types of liquidity events. The second topic is know what you hold, like what actually is the equity, how is it structured. We'll discuss why timing matters. And then we're actually going to go into tax mistakes that can be undone. And then I think the part that we'll try to make sure spend a fair amount of time is on real world examples, right? So we could take it from the abstract to something that's more tangible. Then we'll have advisors 4-step framework, and lastly, we'll make sure to leave time for Q&A so that folks that are listening in have a chance to send their questions. And if I see questions throughout, don't worry, we're saving those. We'll make sure to get to as many as we can in the Q&A. This question will come out throughout the whole presentation as well. Will this call be recorded? Yes, it'll be recorded. But obviously, the fun part of this is towards the end is that you could have a interaction with our panelists. So with that, let's kick it off here with the type of liquidity events. And Grace, why don't you take it away here and just kind of walk us through the different types?
Yeah, thank you so much, Andres, and really great to be here today. I know Christian and I are very excited to talk about strategy and tactics. But honestly, before you can get into the weeds, you have to zoom out with equity compensation and understand what is it that you have, what's the situation going on. So the very first thing that we're going to hit on, which is part of that thought process.
Oh, sir.
Oh, you're fine.
Yep.
Is going to be what is the liquidity event that is driving this this equity that you are holding. Here are the main four that we come across. Some of them have been, are heavy in the news as we're seeing. But understanding what is driving the equity that you hold is really important ultimately because it helps you determine a few things. It helps you determine if there are timing restrictions around the equity that you are receiving, what types of options you even have related to it, and also any limitations that might exist. So for example, IPO is a common one that a lot of people are asking us about. Yes, technically, stock IPOs, you look like you're rich on paper. One of the things you want to consider is there a lockup period? Sometimes these are 90 days, 180 days. So kind of factoring that into your decision making, understanding that when your lockup period ends, so does the lockup period of 10,000 other people as well. So navigating strategies around supply as that's flooding in, Really important to get that. Another quick example on this page would be something like a tender offer, for example. So a tender offer is basically when a buyer offers to buy your shares at a set price. The big thing on this one is that you usually have a deadline associated with it. So now you have to factor in the psychological pressure of, hey, we need to do something, we need to act at this point in time. So really understanding where that's coming from so that you can ultimately make those decisions. So same word, liquidity event, that's kind of the driving factor. The point is that we can have four completely different sets of circumstances that you really need to understand.
Okay, excellent. Thanks,
Thank
Grace.
you, Grace. Yeah. So turning over to you, Christian. So one aspect is the types of liquidity events. The other one is actually what you own, right? What you hold. So just kind of walk us through some of these here.
Absolutely. Yep. So let me start with know what you hold. As you can see, there's several different ways liquidity events can happen. We just saw it on the prior slide. But before we can talk about taxes, strategies, we really need to answer the basic question of what exactly do you own? And one of the first things I like to ask new clients is, tell me about your equity compensation. And most people will answer, I have stock options, I have RSUs. Then we log into their equity portal and we discover multiple grant types, different vesting schedules, expiration dates, and tax treatments. And that's normal, totally normal, but it also means many people are making these decisions without having the full picture. So every good financial decision really starts with good information. Before you build out a strategy, you really need to understand what exactly you own. And that type of planning really creates choices for you. So let's look at the four most common forms of equity compensation. The first one,
Oh,
if you
sorry.
have,
Yep.
yep,
Go for
there
it.
you go. All right, so here's the four basic kind of forms of equity compensation. Let's do a quick gut check though. If I gave you 60 seconds, could you explain every equity grant that you currently own? Most people can't. And again, that's okay, but it's also why planning often gets delayed. So let's start with RSUs. RSUs are restricted stock units, and they're generally the simplest form of equity compensation. They're also very common. When they vest, the value is typically taxed as ordinary income. So kind of think of them as compensation that happens to be paid in stock instead of cash. One common mistake we often see is clients will assume that the tax they have withheld at the vest will fully cover the eventual tax bill. Depending on your income, that isn't always the case, which we're going to explore a little bit later as well. The second one is ISOs. These we're starting to see be a lot more common. Incentive stock options really start to introduce some more planning opportunities, but they also can introduce more complexity. So you have the option to purchase shares at a predetermined strike price. And then if structured properly, they may qualify for favorable long-term capital gains treatment. Again, we'll talk about that here in a little bit. We also need to be aware, though, they can also trigger the dreaded AMT, alternative minimum tax, which we'll also discuss here in length as well. Next one is NSOs, non-qualified stock options. These work similarly to an ISO, but the tax treatment is generally less favorable. So when you exercise them, the spread between the strike price and the current market value is typically treated as ordinary income. And then timing can significantly affect both the taxes and the cash flow on NSOs. And then the last one here, ESOP, so Employee Stock Ownership Plan. This one's less common in companies, but still worth mentioning because they're out there. These are going to be employer-sponsored retirement plans that are funded with company stock. So the planning considerations are different, but can still create significant tax and concentration issues. So quick comment about concentration. Now I want everyone to think about this just for a moment. If someone handed you $3 million in cash today, would you invest 80% of it into a single stock? Most people say no. Yet, Many employees end up in the exact same position because your salary, your bonuses, your career, your benefits, your investments, they're all tied to one company. So your equity can really become your largest financial opportunity, but can also become your greatest financial risk if you never diversify. So again, the common theme today, planning is going to create choices for you. So now that we understand kind of what we own and how it works, Grace is going to talk about why timing is often more important than sometimes the decision itself.
Awesome. Thank you. Yeah, and so a lot of really good points made. If we flip over to the next slide here, there are a few windows that you really need to pay attention to. I would even argue that the 6 to 12 months out can be 6 to 12 plus. My kind of philosophy is the sooner we can anticipate a future event and create some kind of plan around it, the better you will be. Because you have flexibility at that point in time. So this is especially true with equity comp. So knowing what you hold, knowing where it came from, now we can start to get into some tactics and to some planning opportunities. So if we start at this first tier, 6 to 12 months out, what should you be thinking about? Tax bracket planning. So understanding what is going to hit your income and when. What do you have control over or not? So Christian mentioned a couple things, like with options, we actually control when that income is going to hit, right? We can choose to exercise and choose to, at that point in time, accept some form of income or not. RSUs, when those vest, no control. We know that it vests on this date, that is all hitting my income. A lot of us lucky people on the call, you'll have both. You have the options, you have the RSUs, you have everything in between. So it really becomes this dance of balancing controllable income realization in a given year versus uncontrollable income realization in a given year to ultimately help you out in the most favorable way from a tax perspective. So what you can do 6 to 12 months out, bracket management. So spread out sales that you can, exercises. I've seen really tough situations where somebody exercised a bunch of options at the end of the year, literally because of a comment on a Slack channel at the company, which is really common. And stock goes down significantly, still holds the shares, now faced with an enormous tax bill in April, and we don't even have the shares to help with that liquidity. So really understanding like where you can kind of straddle the line between tax years is going to be your friend, and managing your bracket not only with the equity that you have, but also with your household income. So you, your spouse, where does your income bracket sit? What does this equity comp push you into? And managing that all together. AMT management and planning should be happening at this time, and then planning around other income events that might be taking place throughout the year. 30 days out, options become a little bit more limited at this point. We've kind of done a lot of the, we've done a lot of the strategizing ahead of time, hopefully. So 30 days out, that's where, as Christian mentioned, you want to make sure you're fixing your withholding. So some companies, I know that some companies don't allow you to adjust your withholding on your equity to anything beyond the 22%. Others, they provide that basically a quarter in advance, and they say, hey, if you'd like to take up your withholding to 35%, 37%, you may do so. So taking that short-term opportunity to fix your withholding will save you a ton of headache down the road of setting aside the right amount of cash, prepaying that as an estimated tax payment, because if it's not withheld from the W-2, it's not going to count throughout the year, and just making it a much cleaner process for you. So then you basically have after the event. So this is where it becomes more about strategic moves for the holdings themselves, short-term gain versus long-term gain management. So depending on what you own, there are going to be different rules of like how long you have to hold something before selling in order to get that status. But really the idea here is if you get a giant equity, vest of some kind, and your income bracket is very high for that year, probably not the time to be realizing a ton of short-term gains that are also going to hit you in that ordinary income tax bracket. You also have the opportunity after the event to do things like harvesting losses, donating shares in lieu of cash. If you're really looking for a tax advantage, there are really great opportunities with that. One thing I would caution when it comes to, the loss harvesting is a lot of my clients that have equity comp, they're also contributing into ESPP plans. So avoiding wash sale traps with those as well. You sell out of one position and then with your paycheck, you're buying into the other through your ESPP. Some of that can get discounted. So again, this is where preparation and planning takes place. The real unfortunate thing is that most people are coming to me in the bottom category instead of where I would want them to come to me in that very top one. This is where planning really takes hold and where you have an advantage to make your equity work for you without hindering your overall finances.
Grace, how often, in the sense of when people approach you, if you had to kind of throw a number, is like after the event versus, before the event?
I mean, I would say if they're specifically coming to me for equity comp, 80% of the time it's after the event, and it's usually because some mistake, nice transition, some mistake will be made, and they're like, shoot, this was
Right.
beyond, I need help. So that's usually when I'm seeing that happen.
Yeah, that tracks. And hence for people listening in, like if you're after the event, okay, great, you're talking to the right people here. But if you're still before the event, even more of a reason to make sure you don't find yourself in that situation. Well, thank you for that. Okay, and then the next one, I mean, talking about where often maybe they're coming to you after the fact. We have here 5 tax mistakes that can be undone.
Yep. Thanks. And real quick, I just want to go back to that prior slide. That's actually one of my favorite slides that Grace just covered. I just want to reinforce a couple things because it really highlights something we see over and over. Most people think the planning starts when the IPO is announced or the tender offer arrives or whatever the triggering event is. But in reality, the biggest planning opportunity exists in that 6 to 12 month kind of window before the event. So if you're in that 6 to 12 month window, now's the time to start thinking about this and start getting some help putting the pieces together. And you really need to think about that flexibility around your ISO exercise timing, your potential alternative minimum tax planning, charitable giving, diversification. Because by the time the event occurs, many of those decisions have already been made, or the opportunity has passed. All right, Andres, sorry, you can flip to
No, all good.
the next one there. Okay, so let's take a look at 5 mistakes we see most often from a tax perspective. And these aren't investment mistakes, they're really planning mistakes. And unfortunately, several of them can't be reversed once they're made. So the first one I want to look at, mistake number 1, selling RSUs immediately. Now, I want to be careful here because selling immediately isn't necessarily wrong. Holding isn't wrong either. The mistake is making the decision without a plan. So the questions you really need to consider are, how concentrated are you? Do you need liquidity? What's your current tax situation? Does holding support your long-term investment plan? Mistake number 2, exercising ISOs without modeling AMT. Grace would probably agree with this. This is one of the biggest ones we see where that surprise tax bill comes in. And this is one of the most common surprises. Employees will exercise those options expecting to buy stock. Then tax season comes and AMT shows up. And then suddenly you owe taxes on gains that you haven't actually received in cash. So what I want you to kind of remember here around not modeling AMT is we'd much rather discover a tax bill in a spreadsheet than on April 15th. Mistake number 3, missing the 83B election. Now, this one is kind of a special situation. This doesn't apply to all situations, but if it does apply, it's one you need to look at and you need to look at quickly. So this one's pretty simple. You have 30 days from the grant, no extensions, no second chances. And this could, if this does apply to you, you do need to start planning on this one early. Mistake number 4 is ignoring state taxes. Federal taxes get most of the attention, but where you live can also change the outcome of your tax planning. So state taxation, residency rules, and then sources of income really needs to be looked at well before the liquidity event. And then the last one here, mistake number 5, holding everything. So I recently read a Wall Street Journal article about equity compensation, just kind of perfect timing, came out a couple weeks ago. And they really made a great point that people spend years trying to become wealthy, but very little time thinking about how to stay wealthy. And it's natural to kind of believe in the company that you helped build. But remember, as we discussed earlier, your paycheck is tied to the company, your career depends on it, and potential future bonuses depend on the company as well. So what you need to think through here is, does your retirement need to depend on it too? And the key is diversification isn't about giving up on the company. It's really about protecting the life you've worked to build.
Yeah, that's great. So true. All right. So we now get to see some real world examples on situations that both Christian and Grace have seen. So let's go first here with the senior engineer.
Yeah, so we wanted to put some numbers on paper for you guys to make it real. And these are all loosely based off of situations that actually happen and that there are real planning opportunities around. So in this scenario, we have senior engineer. They hold 500,000 in RSUs. Those have appreciated significantly in value over time, which we see. So at the time that they vested, there is a $100,000 vested basis, and then you've just got all this gain on top. So they paid taxes on the 100,000 portion, and then the rest is that gains. Private company, we see an IPO, causes the share price to skyrocket, and we see those additional gains. And so the real event is this IPO lockup release. What does software engineer do in this case? Sell everything immediately in the hype and the excitement. And the answer is really, let's take a step back and see what our options are in this particular case. So without a plan, let's just play this one through. This person sells all of it in a single tax year. We're talking about let's say half the shares are in long-term gain status, half the shares are in short-term gain status for simplicity. They live in California, so we're looking at ordinary income on those short-term shares and the gains. We're looking at California tax. We're looking at net investment income tax, which is the 3.8% add-on based on your income. And then we're looking at long-term capital gains, but the important factor here is that we're not looking at the comfortable 15% long-term capital gains that we all love. We're looking at 20% now, because with their income and then with the threshold that the additional income from these shares brings on, they've actually stacked on more income that has moved them out of that single $545,000 threshold for that 15%. So something you're very used to looks very different in a high income year. What this ultimately yields is approximately $168,000 in taxes paid to unwind the entire position with all those gains, and keeping on hand about $332,000, right? So then let's talk about what if we were to formulate a plan. And again, there are a lot of other things that go into this around what do you need liquidity for? What's our feeling on the stock itself? But for the case of this example, let's just say we say, you know what? Let's sell the long-term lots now, and let's hold the rest for the year. So essentially, it's 50% selling half of it now, half of it in a new tax year when you're fresh, in a new income bracket or in a new income situation, and now your short-term gains have become long-term gains at that point. Under this example, all those gains would be treated as that 15% long-term capital gain. You still have the NIIT, you still have the California, but the big thing is you're avoiding anything being under that ordinary income tax rate. which in that high income year is very, very high. Total taxes paid, still, gut punch, $120,000. But the savings are really real. So you look at those two numbers, and I wanted to give something realistic. But that's a real savings in terms of accounts that you ultimately get to keep. You're getting to keep the $48,000 in your pocket that basically is the result of straddling a sale over the course of 2 tax years instead of 1.
That's great. And that's nuts for just looking at it from the perspective of, someone that worked this hard, probably, if a company's IPOing and they work so hard, it's like all of a sudden now 50 grand difference just for this one decision or indecision, however you want to look at it. Yeah, I'm sure for folks that are listening in and later we'll see this, will hopefully resonate if they haven't done it already, or also resonate as to why you definitely need to think about these things. That's a really good one. And then we have a product manager here with a secondary offering.
Yeah, so looking at the ISO versus kind of the RSU, there are a couple things that stand out here, but let's kind of bring it all together with a real world example on the incentive stock option side. And this is really a simplified scenario, but it is based on the kinds of conversations that Grace and I have with clients all the time. It is an example only. The one thing about ISO situations is they are vastly different for each client, and taxes vary greatly. So what we try to do here is just kind of give you an example of kind of common ones we see. So first, let's meet our hypothetical client. So product manager, California resident, 320,000 salary, 500,000 of ISOs. So a company announces a secondary offering. That's kind of the triggering event. But this could also apply to you if there's an upcoming IPO, or if your options are about to expire. So if you have options that are about to expire, it's a great time to look at these as well. So kind of at first glance, this looks like a great problem to have. And it is, but it's also where some expensive mistakes can happen. So let's start with kind of what happens when someone waits until a liquidity event before getting advice. So typically what I'll see is the employee hears about the secondary offering, again, sometimes through that Slack channel or through the media. They're very excited and they think, okay, this is my chance. So they exercise all their options at once, which sounds reasonable, but several things happen when you do that. So the first one is the spread, without getting too technical, the spread between the strike price and the current value could create a significant AMT or alternative minimum tax exposure. So the takeaway there is that could trigger an alternative minimum tax exposure that you really need to be aware of. There's also a tax difference between immediately selling those shares versus holding them through the end of the year. And remember, you haven't necessarily received cash yet by doing this, but you have created a tax obligation. And again, that surprises a lot of people. The second consideration is because everything happens at once, you lose flexibility. There really wasn't time to kind of spread exercises across multiple years. Again, you control the timing of when you exercise those options. You didn't have time to evaluate tax brackets and use those in your favor. You didn't have time to coordinate with the CPA. And so kind of the third thing we see is now a lot of clients are kind of reacting. It's really reactionary. And instead of kind of thinking through what's the best strategy for them, unfortunately, they're coming to us and asking, how do I pay my tax bill? And that isn't where we want our clients to be. So also notice something important here when you're looking at these numbers. The first one with no planning, the investment itself wasn't necessarily bad. There was nothing wrong with the investment. The options weren't bad. There was nothing wrong with the options. It's really just a matter of timing. And so it's really just a problem of timing. Now, if we look at the right side with a plan, same company, same compensation, same stock, same triggering event, really the only thing that changes here is planning. So 9 months earlier, this example, 9 months earlier, instead of waiting, they get a plan in place. So first they model the tax impact. So before exercising anything, they already understand approximately what the tax consequences could look like. And this is really important. So this makes sure there's no surprises from a tax perspective. And then second, instead of exercising everything at once, they're going to spread the exercises over time. That gives them control over taxes, certainly looking at the alternative minimum tax numbers, helping with cash flow. And again, that planning just really creates flexibility when you're working through these decisions. And then third, because the planning started early, they may qualify for more favorable long-term capital gains treatment on the shares that meet the holding requirements. So again, it's all about planning. It's not about luck. And then lastly here, now that they've entered the liquidity event and they're executing a plan, we're really making decisions kind of based on facts, not emotional decisions.
All right.
And then just a quick comment on the 83B election. I think that's important to call out here as well. So the 83B election, this is really where a certified financial planner can add value and certainly help. But this needs to be done quickly and kind of early in the process. So 83B election is on incentive stock options. It is an IRS provision, but the election is only available if you early exercise the unvested options. So a couple things you got to keep in mind. There's a 30-day rule that applies from the grant. Very, very important. But what this can do is potentially reduce your alternative minimum tax. Going back to looking at the strike and exercise price, when the strike and exercise price are similar, you're going to have some advantages with that 83B election. And then holding periods still apply. So 2 years from grant, 1 year from exercise does give you preferential tax treatment. So again, several nuances, very important to talk to a certified financial planner. And then really the biggest differences between these two examples, it's not the company, it's not the stock. Those are exactly the same. It's not even the equity itself. It's really the planning. So one employee reacted to the event, the other kind of was prepared and ready for that.
Yeah, that's crazy. 80 grand difference just for because of kind of having some planning ahead. And I think that AMT one, I think that's one that a lot of people might find surprising, for not having the plan in place. Thank you so much, Christian, for this one. I think this one's really good. Okay, so now we have the difference without advisor versus with advisor here when it comes to this type of trigger events.
Yeah, perfect. So actually, if you want to go back one slide for me, Andres,
Yeah,
we'll just
sure.
we'll hang on that one for a second. Just kind
Oh,
of a
sure.
couple quick wrap-up thoughts on the examples. And this is again where an advisor can really add a lot of value. The ISOs get really complicated quickly. RSU is a little bit more straightforward, but you really need someone on your side that understands these to help you walk you through them. Most common question that I'm asked is really what exactly does a financial advisor do with equity compensation? So now we've kind of looked at the different types. Let's kind of talk through, well, I guess let me start with what we don't do. So what we don't do, we don't control the market, unfortunately. We don't decide when your company goes public, and we don't change the tax code. What we do is help clients make better decisions before a lot of these events happen. So this often includes things we've already talked about, understanding the grants, modeling the different tax scenarios, coordinating with the CPA, evaluating the different exercise strategies, starting to talk about what's our diversification plan, how much concentration are you okay holding, how much do we want to start to diversify away, planning cash flows, and then also starting to think through how do you integrate that in the comprehensive plan? So retirement, tax, estate, how do we put all those pieces together? And again, the goal isn't really to maximize one transaction, it's really to maximize the probability of achieving your long-term goals. So Andres, if you flip to the next one for me. Thank you. Okay, so everything we've really just talked about is, thinking about tax modeling, diversification, coordinating with your CPA. It really only works if you have the time to make those decisions. And that's really what this slide is about. So one of the biggest misconceptions that we kind of see with equity compensation is when there's an IPO announcement or tender offer. And you really need to start thinking through these things early. So most people think about their equity compensation only when something exciting happens. So IPO is announced, tender offers announced, or the stock price suddenly jumps. And that's what triggers that urgency. But really, that shouldn't be the beginning of the planning. They should be executing a plan that they've already built. And so in most cases, equity compensation, again, starts before you've earned a single share sometimes. Now, most of you on this call probably already have RSUs, ISOs, but something I want to kind of call out quickly is this can often start when you're evaluating an offer as well. So when you're evaluating offers, you really need to be thinking about what type of equity am I receiving? What are the vesting schedules? Are they ISOs, RSUs? What happens if you leave the company? Are there opportunities to exercise early? Is there an A3B election? Not that A3B doesn't apply to everything, but it may apply. And again, this is where if you already have a relationship established with an advisor, they can actually help you compare offers side by side and look at that. So not only is it kind of HR questions of how do these things work, but they're really financial planning questions as well. And then what we see here too is the clients who tend to have the best outcomes, again, aren't necessarily the ones with the largest equity grants. Large equity grants are great, but the ones who start asking the right questions early are really the ones that have the most success. And there's also rarely one perfect answer. So really my role, Grace's role, is to really help clients kind of understand the trade-offs so that you can make informed decisions. And again, that liquidity event shouldn't be the beginning of the financial planning. It should be really the moment when the planning starts to pay off or when you take action. Okay, so we spent a lot of time talking about why planning matters. So next question really becomes where do you actually begin? How do you start this process? So Grace is going to walk us through kind of a simple 4-step framework and bring all this together into kind of a practical place to start.
Yes, thank you. I know everybody on the call is like, okay, so what do I do? This is all great. Obviously, we have emphasized the point of make a plan, easier said than done. So here's kind of some simple things that you can take with you. And everybody on this call can get off and do number 1 immediately and just kind of start from there. So Christian mentioned this, but really to follow this model, the first thing is get an inventory of exactly what you hold. What are the vest dates? Expiration dates. I have a client that had actually her options, they're due to expire in a couple of years. They have increased significantly in value since she received them. The sooner we, identify that and can plan around it, we're able to spread out her exercises over multiple tax years instead of taking that big hit. So inventory, be very specific with the information. If you don't love your equity comp portal, make yourself a nice little spreadsheet and lay out kind of those key dates, amounts, vesting schedules, types. Get really curious about what you have and document that really clearly. The second step is going to be modeling from a tax perspective. So again, you want to start to understand what the tax implications of each of these different types of holdings are. As we've mentioned, they're all different. They all like to have a unique spin. On top of that, tax code is also constantly changing. So we've talked a lot about AMT. If you felt comfortable with AMT, but you're still going off of 2025 information, guess what? It completely changed in 2026. So getting really up to date with what are the phase outs, what is the income threshold, am I there with my income, my spouse's, the comp that I'm looking at here, and starting to model forward, okay, in these cases, if market fluctuates, if stock price fluctuates X and I exercise Y, what am I yielding? What's going to be going on at that point? So 2 to 3 scenarios to model out and running it, in multiple directions depending on where the stock moves. Number 3 is so important. I kind of wish this is the one that was like in bright blue, because this is where people do not do it, and that is to decide. Christian, you said this, and it's the thing that gets missed the most, of making a decision about what you're going to do ahead of time. A lot of times we are reacting. We're coming up on that deadline like, oh shoot, what should I do? Should I do this now? We go off of the news, and we get caught up in the hype. The biggest thing you can do for yourself after you run your inventory, after you do some tax modeling, is to decide, what are you going to do? At what point would you sell? At what point would you hold? And how does that all fold into your overall financial plan? So we're not just looking at this in the window of my equity compensation. We're saying, how does this inject of cash flow either help, hinder, or not make a difference on the overall needs that I have with my broader financial plan? So connecting those 2 dots is so critical, and making a non-emotional, data-backed decision about what you will do in different cases. Literally create a playbook for yourself and say, these are my rules I will abide by in those cases, so you can just run it as the markets make their moves, as your company makes its moves, and as you get new information. And then the 4th one from there is super easy. Then you execute. So you determine what your plan is, you determine how, what are the major decision points that you're going to hit when you actually decide to sell, to exercise, to hold. Then you can set things up in place that help you actually carry that forward, diversify your holdings appropriately. So again, trying to adhere to that, am I overexposed to the risk of my company? Knowing that this is not just a stock exposure. Assuming you still work there, this is a human capital exposure as well. So your job, your career, your everything is already tied up in the success or failure of this firm. Diversify the stock holding where you can to an appropriate level related to how much you want to have. That's going to be the biggest outcome from this execution phase. So that's kind of our 4-step. Like I said, if you take nothing else, I'm very much with my clients about like small steps, do something, like begin to push that big boulder down the hill. Start with an inventory, create your own mechanism to track the important pieces of information. I have seen the equity comp portals and they're all super confusing. I love a good spreadsheet for this. Begin to do that, get curious, and let that naturally take you to those steps 2 through 4.
I think that's great. I would also add to that, know your trading windows. That's something we probably should have mentioned earlier on that we missed, but you're going to have, if you're still working at the company, you're going to have trading windows. Know when those open, know when those close. Like Grace mentioned, have a plan in place ahead of that. So you're not scrambling during that 2 to 3 to 4 weeks trying to make a decision on what the stock is doing. Is it higher? Is it lower? Are we going to hold? Are we going to sell? Have a game plan in place and know those trading windows. I think that's great to add it to that inventory.
For the inventory, Grace, aspect of it, for a lot of people that might be like going to Carta, right? Let's say they work at a startup, like there's different portals, but my guess is if you don't know, like ask HR and they would probably be able to tell you, right, where to get that information.
Absolutely. So yeah, if you don't have your E-Trade portal or your Carta, getting with your team, they should be able to give you the key pieces of information around grant date, exercise price, holding period requirements, comp type. Gather that information and get it stored somewhere that you can access it.
Yeah, no, that's great. All right. So we covered a lot of ground, but we wanted to make sure we left enough time for questions. And I've been keeping track here as the questions come in. The first one that I have here is I have, oh, hold on. Don't want to skip it here. I have RSUs and ISOs both. Which one should I think about first?
I can hit on that one.
Yeah, go for it, Grace.
if we're thinking about from a chronological standpoint, obviously I want you thinking about all of it all the time. Everything connects with it with each other. But I would say RSUs are kind of your first target just because the decision has already been made for you. So ISOs get a slight, not pass, but a delay on the RSUs for me because again of that optionality that we have with it. We get to choose, what we're doing. RSUs, the choice has already been made. Those are vested. You have them. You got to have a plan in place for what are you doing with them at what point in time before you hopefully quick follow begin thinking on the ISO side as well. This is especially true on the tax front. Again, if RSUs vest for you, I can't underscore this enough because it's something that continues to surprise people. But that is taxed to you at that point in time. So that's income. When they vest, that is income. You get a nice vest of 100,000 shares or $100,000 from your signing bonus from 3 years ago. That is your income that has happened already. So the time to think about the consequences of that extra income is immediately so that you can begin to make concessions for it.
Yeah, and I just added that, Grace. I think you're spot on there. Start with the RSUs. Definitely plan around the tax side of the RSUs. That surprises people too. They'll have a withholding on the RSU at the vest date, but then they get to the end of the year and they're surprised that it's not enough. And then I would start with understanding the incentive stock option timeframes. When do they expire? When are they vesting? I've often seen they're granted, and then sometimes they'll vest over a 4-year period. So really know what that vest is, because RSUs are generally taxed when vested, and then those ISOs require really thoughtful decisions around when to exercise and how that may affect the AMT. So now I love that you started with both. You start with both, and then you kind of break it down from there.
Yeah, no, that's great. That's a good one. We got a bunch here. So uh, I already sold most of my shares without a plan. Is there anything I can still do, to fix it or to improve the situation?
Yes, yeah, absolutely. I'll jump in on that one first, and Grace, follow up if there's anything you want to add. So yeah, absolutely. Well, you can't undo the sale, so we can't undo the past decisions. We can still make some decisions around what's next, and so that's going to look like tax loss harvesting potentially. Estimated tax planning, especially if you did it current year. So if we're in 2026, you made the decisions in say Q1 or Q2, you still have time to work through some tax planning. Now's the time to do it. Don't be surprised when April 15th comes. Again, I'd rather find that tax surprise in a spreadsheet or in my planning software than on April 15th. You can also start thinking about how you reinvest the proceeds. You can think through some charitable strategies. Are you charitably inclined? And then really starting to take it to the next level is kind of updating the full retirement plan. How does it fit into the retirement plan? Kind of thinking through the estate plan. So yeah, absolutely. Planning doesn't end after that liquidity event. I think it just kind of changes the conversation a little bit.
Crazy, you like anything to add on your side?
No, just like with that one, the mistake I see over and over again after the sale is underestimating the taxes. And so a lot of times if we sell, you sell your shares, that might just end up as cash in your high yield savings account that you then spend on remodeling your bathroom, right? Then April comes around and you have a $15,000 tax bill because you withheld at 22%. That's the one. If you already sold it, just go back and see what the basis was on that original vest versus what you sold it for, and make sure you are setting aside the proper amount of cash to pay that tax bill. Or better yet, if you feel confident about it, making an estimated tax payment so that you're not left, kind of high and dry with a huge tax bill in April that you weren't expecting.
And don't be intimidated by the estimated tax payment. So one of the things I think that the government does really well actually is the IRS's website I think makes it really easy to make estimated payments. And as you start to have some of these equity compensation decisions happen, you probably will need to be making some quarterly estimated payments. It's pretty easy. It's pretty smooth. You set everything up on the IRS website, you make your estimated payments, and off you go.
Yeah, those are really good ones. I'm seeing here. What else we got? Okay, how do I compare a job offer with high equity to one with a higher salary and no equity?
Oh, I can hit on that one. Um, Honestly, like cash beats a promise on that one. Um, with a caveat, right? Like equity is how people become uber wealthy. But you need to be very aware. Again, I'll harken back to the first slide that we went over. What is it? What kind of equity is it? What type of liquidity event needs to happen? So I review job offers with my clients frequently, and some of them come with these really, impressive sounding equity packages from private companies. And these are based on valuations that they have done internally, based on a potential future sale that may or may not ever come. And so before accepting something like that, before accepting a job on the promise of like, wow, this could be worth $1 million if X, Y, and Z happens, really try to understand, well, what assumptions am I making here? What is the probability of these things taking place? Ask them for their financial statements if you want to, like I've done that before. Like, hey, I want to see if this feels like it would be worth something. Can they show us anything that tells us a little bit more about, the financial analysis behind these numbers? Is this realistic, these numbers that they're putting out there? You can ask them directly in those cases, how long until you're targeting a liquidity event. Some people have very clear planning around that. And they're like, well, we've been shopping around for 5 years. We're planning to sell in 2 years. Other people, you'll get it right off the bat. No clue, TBD. Those are the ones I would take with much more of a grain of salt. So I think the original question was, what's better? What should I pay more attention to? Cash is money in your pocket. Cash is paying your bills. Cash is redoing your bathroom. Cash is getting your groceries. That's kind of that's going to anchor you into reality. If you're going to begin to put weight on an equity package, really dig deep into what does this mean and what is the probability that this actually becomes meaningful to me.
Yeah, one thing that I'll add on that, just even on the personal note, is asking if they've had, for instance, like have they had a tender offer before, right? Like, if they have and they're saying, yeah, we usually have one every 3-4 years. It's like, yep, and we had one 2 years ago. It's like, okay, well, they had one 2 years ago, and therefore it's not just a piece of paper. Like they were able to, that increases the probability maybe that they would have one again. But you're right, Grace, is like those questions are critical, especially if the company that's offering equity is a substantial portion of their total compensation, right? Um, I would caveat in a sense if it's equity and it's 5% of the total compensation and you're more junior, I don't know if I would ask for financials and the whole nine thing because it might be like, come on, cut me a break here. But if it's like, no, it's half your compensation, and then yeah, like if you want half my compensation to be something that's just a piece of paper, like I do want to see a lot more financials and understand, what that actually could potentially be valued. No, that's great. Anything on your side, Christian, you would like to add on that?
Yeah, I guess I'd also add, and Grace kind of hit on this. Is it public? Is it a publicly traded company or is it private? The private side potentially has more upside, but it's also a little bit more of an unknown, a little bit more of a risk.
Yeah.
The public side is a little bit more of a known. Like that's pretty easy to kind of figure out on the known side. So if it's a publicly traded company, maybe that's not as much of a concern. And then I think it also comes down to personality. I work with a lot of clients that are very conservative. I work with a lot of clients that are also more aggressive. So it comes down to your personality and kind of what you're comfortable with, right? The kind of that what keeps you up at night question. If a large part of your compensation tied to equity comp is going to keep you up at night and that's going to make you nervous, the higher salary is probably better. Cash in pocket is better. You can diversify. You can build wealth through other mechanisms. If you want to roll the dice a little bit, take a little bit of that unknown. Warren Buffett is famous for saying, concentration builds wealth, but diversification preserves wealth. So you got to kind of figure out your own personality and decide how you want to move forward there.
Yeah, if there's anybody from Anthropic and you did this 5 years ago, yeah, I would tell you take more equity back then. Now we don't. Now we don't know. But there's not for every Anthropic. There's many that are not Anthropic, right? So that's the real. That's where you have to kind of assign a probability of what it could become. So there's a bunch more here. Okay. Do state taxes change anything if I relocate before selling? Grace, you wanna take that one?
Yeah.
Or Christian?
Yes, it depends on the time period. So you can't just get your sweet equity package in California and then pack your bags a week later and move to Texas and let those vest over there. So there are timing limitations that are going to be state specific. Like I know I think California has got some pretty harsh rules on where equity was specifically granted and how long you need to how long you're a resident de facto there if you did move. Obviously, because it's tech hub, and I think it's becoming very common for people to think about ways that they can shelter that. So from a portability standpoint, it's absolutely something to look into before you make any life changes to help shelter some of the state taxes. From a planning perspective, also very important. So it's obviously a completely different situation if you are living in Texas and you have these big grants coming up or vests. You don't necessarily have to worry about the same thing like state capital gains and things like that. You don't have to worry about that versus if you're living, especially in a high income tax state, you're going to want to model that out. Like California's got some pretty rough brackets when it comes to capital gains on those assets as well. So incorporating that at a state level into your modeling is going to be very important. That step number 3 that we talked about.
That's great. And actually keeping an eye on time, there's a number of questions that are all asking basically the same thing, which is how do I get to, talk to Grace and Christian and, potentially work with them. So to end on that one, you could just take this QR code here and schedule some time. And essentially, like what we would do is speak on the Zoe side to make sure, in essence, that the Grace and Christian is the right person for you. Obviously, you could look them up on LinkedIn, reach out as well directly. But I know that for a lot of folks, that might be the right answer in the sense of trying to identify on the personal side what makes sense the most for your current situation. So with that, I want to pause there, right on time here, and thank Christian and Grace so much for your time, your expertise. I thought this was a great session and a very topical topic here when it comes to a couple of companies going public, a number of tender offers that I know a lot of folks listening in benefited a lot from. So thank you so much to both of you.
Thank you, Andres. This was so fun and really appreciate you giving us the platform.
Yeah, thanks for having us, Andres. It's a good thing you capped us to an hour. Otherwise, Grace and I could talk about this all day. So,
well, same here. I love this stuff. I think there's so much benefit on having a conversation about it. Thanks so much for everybody else that dialed in. We'll make sure to have this recorded and send it via email if someone joined late, etc. Yeah, we'll end it there. Have a great rest of your day, everybody. Thanks for joining.